both those metals are poised for a shift out of incremental bull trend into something that chaos theory people would enjoy. Rapid ascent. Break all the models of how you've behaved for the last few years and start to go vertical. And I think that probably will be partly an effect of asset managers saying, I knew this thing would break. I'm getting out of the stock market to some extent, and I'm moving that money somewhere else. And one of the good areas to me looks like gold because it's behaving well and the miners are undervalued. And I think that's where you'll get the goose in the monetary metals. It's just the anticipation of the stock market wobbling.
MichaelOliver from Momentum Structural Analysis predicts a surge in gold and silver, possibly driven by asset managers during a stock market wobble. Michael also notes historical trends, highlighting silver's outperformance during surges and on the downside when gold pauses. After lagging gold in 2023, silver could outperform in 2024. Silver's industrial demand has been stellar, bucking the general trend in industrial metals in 2023. Silver's price, however, could have benefited from that high demand and tight supply. As silver's correlation to industrial metal prices weakens in 2024, that should help the metal to shake off some of the baggage that has been weighing it down. Oliver applies this analysis to gold miners, citing the summer of 2020 when a 40% increase in gold led to triple gains for miners, characterizing it as a slingshot-type market. In the last significant upswing of gold in mid-2020, GDX surged by 134.1%, magnifying gold's gains by 3.4x. A modest 25% growth in this current upswing could propel gold to approximately $2,275, surpassing December's $2,077 and generating new record closes. Exceptional results from gold miners in the last and upcoming quarters are expected to reignite enthusiasm for this promising sector. Dismissing a consistent connection between the stock market and gold, Oliver highlights sporadic instances of their simultaneous bull markets in the past 50 years. In the 2008 financial crisis, gold initially fell alongside the stock market shock. However, it rebounded and ended the year with a 5.5% gain. Throughout the 18-month stock market sell-off, gold surged over 25%. This history suggests that even if gold experiences an initial dip during a market collapse, it can present a promising buying opportunity. Now, we present the clips of MichaelOliver's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
The silver-gold spread will shift. In fact, you've seen that anytime you see a surge that lasts, let's say, a month or so in the monetary metals, generally silver will beat gold. And similarly, when gold pauses or pulls back a little bit, silver will beat gold on the downside. So it's a wild child. And the same is true with the gold miners. You know, there have been points in time, especially that summer, the spring to summer 2020, when gold went up, 40%, and they went up triple. They're slingshot-type markets, silver and the miners especially now. And I think the biggest slingshot I've ever seen, possibly in my entire career, which goes back to the mid-'70s, is what the miners are set up for right now. I think there's some big guys out there who may not be looking at charts like I am, momentum charts especially, but realize just on a fundamental basis that this is a place to be. Nobody wants it. I'll take it. While the stock market caves, if you think gold stocks go with the S&P, look at the chart the last 3 months. Total opposites, okay? So expect that to continue. Stock market goes down, those gold miners are going up because they're going to be grabbed by a lot of asset managers. Well, it's not been one really for a long time. You could go back and find a few periods over the last 50 years where stock market was in a bull and so was gold, but generally gold led. Well, for example, gold was a bull from 2000 to 2008, and it had that nasty October, part of September and October. And then by March of the next year, while the stock market was making a new low again, March of 2009, below the October crash low of 2008, gold was back at its highs, which had been around $1,000. And then gold proceeded to double over the next several years, 2009, 10, 11. So the next several years, it doubled from 1,000 to almost 2,000. At a point in there, after that March low in 2009, the stock market did, in fact, turn back up. And you could almost argue, well, the stock market's following gold. So it wasn't the other way around. Remember, gold's been around for thousands of years. And it's no matter what some people might like to say, it's not lost its intrinsic value as money. It's still regarded. You can jump from a plane and parachute in almost any country in the world and land, and I don't care if it's a civilized world or what you might call primitive. They know what gold is. Okay, it's universal, and a lot of people are becoming aware of that again. Not so much in the U.S. government, but in a lot of other governments, for example, are buying the heck out of gold. We know that, and there's no doubt reasons for that. But anyway, no, the linkage is pathetic. It's coincident a few times in history, enough to burn it in people's memory. They're linked. No, they're not. So right now, all we're looking for is the initial wobble. And I think gold will see that clearly. And as far as a number for gold, we know it got to 2150 back in December. Didn't stay there, but for a few hours. Buy stops being triggered, okay? And then there was a vacuum of buying underneath because you triggered all the buy stops. And since then, you've consolidated mostly above 2000. We had a brief dip in the 1980s in late December, and again this past month we dipped down to 1990 something. But basically, it's in the 2000s. If you get back over 2100 again, not back to the highs at 2150, just get back over 2100, we've got some metrics that say lid's coming off. I don't think gold's going to wait for a whole lot of evidence from the stock market to say, okay, game on. It's going to look for the initial evidence because gold is an anticipatory market. It doesn't normally make its moves based on a hard piece of data, for example. You might see an hourly or daily action based on disappointment or happiness to do a data point. But the big trend structures in gold tend to break without any headlines in anticipation of likely headlines to come. Gold's a smart market. And I would say right now, you get back over 2100 gold, you're gone. Silver back over 2350 again is going to look good. Right now, we're just below 23. There's some big triggers on silver as well that say launch time. And by launch time, I mean where you go up in geometric fashion, like we did in the spring and summer of 2020. Silver went from under $20 to 30 in about 6 months. So percent-wise, I think the real liftoff point for silver is just above 25. And we get very specific in our reports. We update the numbers and if they change. But both those metals are poised for a shift out of incremental bull trend into something that chaos theory people would enjoy. Rapid ascent. Break all the models of how you've behaved for the last few years and start to go vertical.
MichaelOliver underscores gold mining's resilience to smart investors as the most undervalued market, especially during potential stock market wobbles. In 2002, the gold miners index surged 66.8% against the S&P 500's decline of 23.4%. Some gold mining stocks like Newmont and Barrick Gold saw even more dramatic gains, exceeding 100% during the 2000 to 2002 bear market. Investors flocked to gold mining equities for safety while the rest of the market slumped. Since mid-December, MichaelOliver notes a correlation between the Federal Reserve's stance and the performance of S&P, gold, silver, and T-bonds. Let's get back to the interview.
Some stocks can go out of business because, well, aside from business malfunctions, but the nature of what they fabricate or what they deal in. You can maybe be a chip maker that the world no longer needs your kind of chips. You're gone, et cetera. But you're not going to, gold miners, unless they're there's speculative ones always, and there's some that go out of business just like in any industry. But basically, it's ground to theoretical zero right now. And I think some smart money is seeing that and starting to make the move. And not concerned they're going to make money this month, but probably they got a major low in a major market that's the most undervalued it's ever been relative to gold, relative to the S&P, relative to anything. And it isn't going to zero. And they're already taking the step. Now, there's other asset managers who haven't done it, but they've been listening. Druckenmiller did this. I wonder why he did that. Paul Singer did this. Well, why did he do that? And so they're thinking about it. It's got them thinking and doing some homework. And so what we argue, and we've argued since mid-December, that's when the Fed minutes came out. And the Fed basically said, we'll cut rates maybe next year, but we're not going to raise rates anymore. Okay, now I don't think that's changed really. There are few commentators have said maybe they'll raise rates. I don't think that's going to happen. And I don't think most people think it will. But the issue is, when will they cut rates? Well, maybe that doesn't matter. The point is, maybe it's already the Fed party is priced in. And if you look at an S&P chart starting in mid-December to the present, it's this. Look at a gold chart since then, it's that. It's down and then sideways. Silver's been down and then more down, not to lower lows, but more down than gold. Gold's been sideways. And the miners have been punished. And another market that's also moving with gold is T-bonds, price-wise. In other words, as gold has pulled back, this is true for the last year and a half, actually. The bond market's been fairly well synced with gold, not with the stock market anymore. And I'm suspecting that you get enough wobble in the stock market, especially due to this NVIDIA bubble possibly being pierced at some point, then some of this money is going to flow somewhere. And I think a lot of people are going to move into the gold miners because of the reasons I explained. And it's such a tiny little sector that we've described it to be like a wet bar of soap being grabbed. And I think you got to be aware of that. So if you're thinking in terms of an investor, not a trader, you got to be looking at the gold miners. Gold's behaving quite well. Miners aren't. Is that going to continue forever? No. So think about it. A couple big guys have, and a lot more of them will once the stock market starts to wobble. Do we think we're near a wobble point? Yes. If we see that today's high holds where it was in the S&P and the NASDAQ, we're near the end of the month now. There's 4 more days left before the month ends. And if we don't extend monthly momentum beyond where it's already been with today's high, which is the high of the month in price, it did not take out the momentum high of last month. So when you look at a monthly momentum chart of the S&P or the NASDAQ 100, instead of seeing strong December, strong January, strong February, you see a strong December, a flat January, and a slightly declining February. So momentum is actually paused and built like a range at a high level. So it's overbought and it's stalled. All it's going to take next month, meaning starting Friday next week, is to downtick 1% or so in these indexes. And I'm going to start snapping the momentum lows we've seen in February and January and December. It won't take much. So what we need to see right now to get that rolling is, I think, simply a pause and perhaps a minor pullback between now and the end of the month. At that point, we say, get ready. The stock market's probably ready to downturn. And I think gold won't wait for that. See what's happening today, for example. Gold's about $20 off its low. The stock market only began to wobble a bit. I think it's inverse. So watch the stock market if you're in gold, because as the stock market gets more evidence of wobbliness, watch gold, because it's going to say, okay, we're inverse. We're now going back up. And I think the miners will too.
When stock markets decline sharply, many investors shift funds to traditionally safer assets like gold that are uncorrelated to stocks. This raises the price of gold as demand increases. Moving forward, we anticipate silver outperforming gold, with a projected 9.2% gain in the next year, compared to gold's 7.3%. By the fourth quarter of 2024, we expect silver prices to surpass $26, reflecting its historical leverage to gold, where a 1% increase in gold often corresponds to a 1.4% rise in silver. How will the expected rise in gold and silver coupled with the resilience of gold miners? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.